And Gwynn, I know how the markets are reacting to today's inflation report. Really blowing through the roof here. Thanks for coming on. Could you, just for our listeners who might just be joining, could you give us the headline numbers that we saw in terms of the consumer price index that came out this morning at 8:30?
Yeah, so overall inflation is up 7.7% from a year ago in October. And, that's the smallest rate of increase since January. So that's, some really good news finally on inflation. And core prices, which are, exclude food and energy prices because those tend to be volatile and don't really reflect the underlying trend of inflation, those rose less than expected too. They're up 6.3% on the year. And that's, down from 6.6% in September, which was the highest in, 4 decades.
So call me a pessimist, but I've been trying to look through this report, finding any indication that things are going in the wrong direction. And I have to say that really across the board, this was a again, improving inflation report. If we had looked at this in the context a few years ago, this would be shocking and a really high level of inflation. But in the context of what we've been dealing for, like you said, the last 11 months, this seems to be really good news. What are we seeing in terms of markets reacting to this, in terms of bond markets, equity markets, in light of this better than expected inflation report?
Yeah, markets are clearly loving it. Stocks are up a ton, bonds are rallying. This is clearly fueling hopes among investors that the peak is behind us and that the Fed can slow the pace of rate hikes. And that, ultimately means that if they have to tighten less, then the economy will probably weaken less and stocks will do better. It's hard not to agree with you. Like there is really broad-based declines or deceleration all over this report and in a way that we haven't seen in a really long time. But it's one report. And, there's a possibility that, we'll look back and be like, that was the turning point, that October. But, are things really turning around in a meaningful way? We'll have the November CPI report come out right before the Fed's December meeting. So that'll be crucial, as will the jobs report.
As we head into the end of this year, are there specific items that would concern you about inflation flipping in the opposite direction? I mean, obviously, energy prices are going to be highly unpredictable, partially dependent on what sort of winter we have, what's going on in Russia and Ukraine and China. But are there other areas that you're looking at for either areas of improvement or, potential areas that could worsen going into the end of the year?
So goods prices are finally coming down or decelerating in a pretty reassuring way, but we've been expecting that for a really long time, right? The used car prices, they finally declined quite a lot. And furniture declined a bit too. And, with supply chains improving, that's been expected to flow through to consumer prices in a way that we haven't seen until this report. So good news there, yeah. But services, it's a little less clear, and that's the part that reflects rising, the big increase in wages we've had over the last year. Services are more labor intensive, so things like medical care, education, child care, personal care, those price gains are still pretty firm, suggesting that the tightness of the labor market just means that there's underlying inflationary pressure that it might be hard to wring out of the system. So seeing those start to cool down in a pretty compelling way, that would be the reassuring sign for a lot of economists I talk to.
I also do have to point out that while the Federal Reserve and Jerome Powell specifically certainly look at CPI and glean data from it, their preferred measure of inflation is the PCE price index. We'll get that report for the month of October in a few weeks. But do you suppose there's a possibility that these two don't move in lockstep in terms of showing a slowdown in price increases?
Yeah, that's a big possibility. I won't get into the wonky specifics, but some of the categories that moved kind of decisively in the CPI report maybe are calculated differently or weighted differently in the PCE that the Fed prefers, and So that could mean that we see less of sort of the reprieve we got in October from the CPI report. On balance, the Fed's looking at a lot of different indicators and, also looking at wages and, just the labor market in general and inflation expectations. So it's good. There's a more composite picture, which means that this report on its own is probably not going to change Fed decision making very, very much.
Gwynn, I'll put you on the spot. You're Fed chair for the day. The next meeting, is it a 50 or 75 basis point increase, or neither?
It seems I will go with the consensus of what people seem to be expecting now. This puts us more on track for a 50 than a 75. It just makes it easier for the Fed to think about that smaller rate increase. It's a little more reassuring. They don't have to tighten as aggressively as they have been doing. But, the jury's still out on whether that will translate to their how long they keep rates high. And, Powell telegraphed that the plan is to keep them high for longer than most folks were expecting.
Gwynn Guilford from the Wall Street Journal joining us this morning to talk about today's CPI reading, the Consumer Price Index. Gwynn, thanks so much for coming on. Appreciate it.
Thanks for having me.